If you haven't been offering tax advisory services, this is a time to start reaching out to your clients. The One Big Beautiful Bill passed in the middle of the year. We have 6 months left. We want to start implementing some strategies before the year end.
Welcome to Deduct This, powered by ProConnect Tax. This is where tax professionals come together to share ideas, experiences, and fresh perspectives to help you grow your practice and your future. We're glad you're here. Let's get started.
Hi, and welcome to another episode of Carrie and Lexi Deduct This. I'm Carrie.
And I'm Lexi. It's great to see everyone today. So today we are unpacking one of the hottest topics out there right now that has the tax world buzzing. It's the big, beautiful bill and what it means for your clients and your practice.
That's right. So tax professionals, you guys need to keep up to date and really understand what's happening in the news and changes and things that are going on with the government, and really basically to make sure that you're ensuring that the clients are positioned for success in the next tax season.
Exactly. And today we're thrilled to have a special guest with us, Nadia Rodriguez. Nadia, thanks so much for joining us. Nadia is a tax expert and she's a tax and accounting pro. She has been digging deep into the details of this bill and what it means for not only herself, but also other tax pros. And so we're super excited to have her with us today.
Hi, Lexi. Hi, Carrie. Thank you so much for having me.
Oh, we're so excited to have you. Let's jump right in and let's start talking about all these different pieces and parts. And so what is what's the most impactful part of the big, beautiful bill that you're seeing right now?
There's so much information on this bill, so much media is out there. But the way I like to think about this bill is breaking it up into three separate buckets. So we have the first bucket of those provisions that are extending or making permanent what we've known and what we've been familiar with, which it was going to be doomsday at the end of the year because it was going to go away. Everything that we've known for Tax Cuts and Jobs Act, the TCJA Act, was going to go away at the end of the year 2025. So that first bucket that I'm talking about, the provisions in the One Big Beautiful Bill, it came in and made those permanent. There's no more expiration dates. So that was where, we're familiar. We don't like too much change. But then the second bucket that we're going to talk about is the brand new provisions that are coming in. The ones that we haven't even heard about, have not been familiar with before the passage of the bill. And those have to do with new deductions that now are allowed. And then we have a third bucket, which is not only are we extending some of the provisions and making them permanent, but we're also enhancing some of those credits and those provisions that we were familiar with.
Yeah, that's awesome. And so thanks for the overview of what we're going to dive into today. And Nadia, I want the viewers to hear and listeners to hear about your background and your role in tax and advisory services, because you have a wealth of knowledge that can just be shared. And so can you give us a little bit of background?
Yes, of course. So I am CPA, certified public accountant, and I've been certified for over 15 years. I currently do work for Intuit, where I do speaking engagements on thought leadership into advisory, tax advisory. I do tax webinars. So education is a really important part of our life, as we see right now with the whole One Big Beautiful Bill, keeping up with the tax provisions, the new tax bills. So that is one of my roles with Intuit, is doing the webinars and being part of teams to educate and to bring awareness into how we need to make sure that our products have the tax consistency across and accuracy.
Love it. That's awesome.
Let's dive into some of the pieces and parts about the bill specifically so that tax pros understand what's in it and then how it's going to affect their clients. So these things are going to be about deductions for tips, overtime, auto loan interest. These sound like a big deal to me. So how can tax pros guide their clients to be able to take advantage of some of these deductions?
Yeah, these are new deductions that we have not been familiar with, and those are the ones that come in with this bill. So yes, if we talk about new deductions that are allowed, the no tax on tips is what it's known. It's a deduction up to $25,000 for qualified tips. Now, there are income limitations. So if your income is over $150,000 or $300,000 if you're married filing joint, then that $25,000 of a deduction starts to get reduced. And so when we're talking about the tips, it's qualified tips. And I think it's just the awareness that we have to bring to our clients of what is qualified tips versus non-qualified tips. I think the biggest responsibility that lies in right now is the IRS to give us guidance on exactly which industries are available to have this type of deduction, and also the reporting requirements. When we're talking about W-2s, how are qualified versus non-qualified going to be treated on here? and self-employed, which you're not really thinking too much about self-employed, but self-employed, they receive tips. We think about the Uber drivers, the Lyft drivers, they also receive tips. And how is that going to get reported on their forms, the 1099 NECs or any type of reporting statement? And so that's what the IRS is busy right now, because they do have 90 days after we enacted this bill, which was July 4th of 2025. They have 90 days to come back with us with guidance and reporting requirements. So they have their hands full. So that is one of the deductions, right? And then we're talking about overtime, the qualified overtime. That is 12,500 for each taxpayer that has that qualified overtime. And so the awareness that we need to bring to our clients is which of our clients have been paid in overtime, which ones do receive overtime compensation, which before it didn't really matter. It was taxable income. You get taxed on all of your wages, including overtime. We didn't care about the differentiation. Now we do. And so the awareness that we should be bringing to our clients is having that open conversation with them. Are you salaried? Are you qualified? Are you getting paid qualified overtime? And so let's have that conversation. And then we have the car loan interest, because I think we're getting a lot of questions from clients of, I would need to go buy a car. I want to make sure that my interest will receive a deduction, because what they've heard and what is the law is that there's a deduction up to $10,000 for interest on a car loan. And so this is a conversation we need to have, because there are some requirements that must be met. First, the income. Are they earning more than $100,000 for the year, or $200,000 if they're married filing joint? Then that $10,000 of a deduction starts to phase down. And then it has to be a brand new car. So let's open the conversation. Let's talk about car loan interest, right? It has to be a brand new car. And the actual car has to be final assembly in the United States, not the entire North America. It's really just limited to United States.
I love that you just broke it down like that, because, you hear these things thrown around about all these changes in these different industries and categories. And then people are going to their tax pro saying, oh, I bought a new car. Like, this is it. I love that you broke down the qualification, because these are the things that tax pros need to explain to their customers and their clients as they're having these conversations. And it may impact what they buy, right? Because some are qualified and some are not. So thank you for breaking that down. Let's talk about SALT deduction. First of all, what does that even mean? I'm going to stop there. And what is SALT deduction?
Yes. So SALT deduction, right? We all know it by SALT. And those of us that are in the industry, it's like, we don't really, when we say SALT, I bet our first thought is not the table salt that we use for cooking. It really is what SALT is in the tax code. So SALT stands for state and local tax deduction. And that is what we'll find for itemizers on a Schedule A. And so we've been used to a cap of only being able to deduct $10,000 on Schedule A. And that is on the amount of taxes that you pay on your state income, on your sales tax, the amount of tax that you pay on your property, on your home residence. And so we've been very limited to only $10,000 with TCJA. What happens now with the bill, that cap of $10,000 goes up to $40,000. And then in 2026, it goes all the way up to $40,400. And we keep on going up with inflation all the way up to the tax year 2029. Once it hits 2030, then we go back to what we had been used to, the $10,000 cap. So this is where we need to start identifying those clients that will benefit the most from this. Those clients that are in those states that are subject to state income tax, those that have the large bills on state or on sales, property taxes on their homes. The real estate is, taxes are pretty high. I live in Texas. We don't have a state income tax, but I do have clients that are out in California. They have state income tax. And so, yes, let's start identifying those clients. If we're not too familiar, start grabbing your list of those clients to bring that awareness of, let's start tax planning for them. Because now our deduction is up to $40,000 for 2025.
Yeah, and you said it perfectly. It's each state is different, so it's getting ahead of that and taking a look at how does this affect your different clients in each of the different states. So absolutely.
Yeah, for SALT. And then one of the things that is a little bit different that we had not been used to is we had the $10,000 cap, but we didn't have to worry about their income limitations. Now, in order for you to have the $40,000 of a cap limitation, you have to look at your income For those
Mhm.
that are over $500,000 of income, then that $40,000 starts to get reduced down, and it can go all the way down to 10,000, what we were used to before.
Okay. Great. Great
Yeah,
info.
it's so helpful to understand the caps and how people are going to qualify for these different pieces, right? You need like a flow chart to be able to figure out like if dead statements for each one of these things, right? So it's helpful that you're breaking them down that way. So let's jump in a little bit more. So one of the things that I keep hearing about is that the energy credits took a surprising hit with this bill. So what advice do you have for your clients who've been maybe planning home improvements or other things with the previous credits?
Yes, I think this is the one that has probably the most immediate impact of communicating to them because, like we were talking about the car loan interest, maybe they're thinking about making these purchases for the home improvements like windows, HVACs, or maybe those that produce the energy like solar panels. Those are pretty high ticket items. And if they're thinking about it, they have a deadline. Our first deadline that we're talking about is December 31st of 2025. So 2025. So that is the deadline that they have to install and have these solar panels producing the energy by that date. So yes,
Mm.
let's have a conversation with our clients because again, these will take usually solar panels. There's a process. You pay, the solar company for this equipment. They probably won't install it until a week later or 2 weeks later, depending on their schedule. We need to have the solar panel producing the energy being installed and completed by December 31st for 2025 to qualify for that credit. Now, for big energy property like a solar panel, it is 30% of the whole cost of installation, the property that we're paying. So that's a pretty nice credit. I've had clients who have benefited tremendously from this in prior years. There's been bills of maybe $80,000 that they pay for solar panels, and 30% of that, that's a credit that they've been getting on their tax return. So yes, the deadline is coming up. That's one that we need to communicate with our clients.
That's super helpful. We're here because right, that's 5 months away from right now. And I'm
Mhm.
assuming that you have to not only find the people that you're going to work with, you have to, figure out what's the cost going to be. You have to make sure you have the out of pocket dollars to be able to spend it. And then, like you said, that actually has to be working by December 25th.
Yes, yes,
Okay.
and that's really important. You can't prepay for something on December 31st and have it installed on January 1st of 2026.
Okay.
That will not be considered and qualified for this credit for home energy on the
That's
resident
great.
improvement.
Yeah.
Mhm.
Great information. I actually have a question for you, Nadia. What is your great source of truth for all these dates and all of these changes? What have you been using? I know that we have some of them in our software and Intuit's been doing, we have upcoming webinars, which we'll link later, but what have you been using for your source?
Yes, and it sounds like I have all of this memorized, but no, I definitely do not. There are so
You're
many
so
things.
well
I
spoken.
I constantly go and refer back to the articles that we've been writing. Our source of truth is the tax law. Now, this new bill, this one big beautiful bill, is integrated into our internal revenue code. So the sections that we're reading, and so that's what we've been doing. We've been comparing to what passed and got signed, and how is it looking in our internal revenue code. And so we have articles that we have written. There's a webinar that we are conducting. It airs on July 29th, and
Love it.
it packed with dates and amounts, and it's a great source of truth to come back to refer to, because yes, there's you have to keep in mind all the dates that are coming up, the
Right.
income limitations. Does your client even qualify for these type of deductions, or are they a high income earner where there is no need for them to even consider what's qualified versus non-qualified tips or overtime if they're going to completely phase out and not be entitled to the deduction?
Thank you for that because I think it's really important because it is a little overwhelming for some and that's why there's so much buzz, right? And there's big changes and there are deadlines and they are different for each different set of things. So I want to talk about another one that I feel like I've been seeing all over people talking about it and breaking down, and that's the child tax credit and what the changes are happening there and what tax preparers can really start helping their families understand about this.
I'm glad you bring that up because it is one of the provisions that came in with the bill, and there's a
Mhm.
lot out there. And so, what do we communicate over to our clients? One, the child tax credit has been always 2,000 with TCJA. We've had it for $2,000 of a credit per qualifying child. For 2025, what the bill did, it increased it and enhanced it up to 2,200 per qualifying child. But another thing to note with that is that now the requirement of that taxpayer claiming the child tax credit must have a social security number that is authorized to work. That is new in 2025. We didn't have that in 2024 and prior years. So I think as tax pros, do we have clients that are ITIN holders? Do we have clients that do not have a social security number? Because we need to bring that information, that awareness to them. Because in prior years, they've been used to or depending on this $2,000 credit for each qualifying child that they have, which has had to have social security anyway, the child. But now with the new requirement is that the taxpayer, the parent, the guardian, taking and claiming this type of credit, they must have a social security number. But if you are married filing joint, only one of the taxpayer or the spouse must have a social security number. It could be an ITIN holder and a social security number if it's a married filing joint return. So I think this is the one that's going to really bring that financial impact to our taxpayer clients that are ITIN holders and bring the awareness so that we can help them with advisory services on adjusting the tax withholdings, adjusting their quarterly estimated payments, which are coming up, in order so that we can account for that financial impact of losing a child tax credit. But one of the things is that that did not change with the law is the other dependent credit. So if you don't qualify for a child tax credit, you could, for the same child, you would qualify for the other dependent credit. And that is $500 and does not require for the taxpayer to have a social security number.
Okay, great. Yeah, thanks for clarifying that.
So now I'm thinking about all these different, nuances of this bill. And how do you think about when you think about all of your clients? Do you put a spreadsheet together and go, all right, these people have kids. These people have talked to me about, home improvements or things like that. How would you suggest people go about talking to their clients and being able to go through each of these different, parts of the bill with them?
Oh yes, definitely. The community, it's hard, right? Especially you have a big firm with a lot of clients. How do you start differentiating which ones have that high income, high earners, or are below those income thresholds and are thinking about the cars or the ITIN holders? It really is running the reports. And I would start off, step number one is mass emails to my clients. Maybe if I do have a website, have something on my website, my landing page. If I have a client portal, that I have my clients, some awareness of what's coming up. And this is the time definitely to start. If you haven't been offering tax advisory services, this is a time to definitely start reaching out to your clients about tax advisory because this is where it benefits them. This is the bill passed in the middle of the year. We have 6 months left, or we're now, with time, it keeps ticking. We want to start implementing some strategies before the year end. So definitely start recommending reaching out. One, start advising and start providing these advisory services to your clients.
Yeah, that's great advice. It's a key time to be as organized as possible because there are some big implications here. And you mentioned something. It's different for each group of clients, right? So I know that there's been some big changes for specifically seniors and homeowners. And I know that those are funny to group together because there are also seniors and homeowners. But talk a little bit about those two groups and what our pros should be really emphasizing to these groups to make sure that they are getting, understanding that what they can do with the changes.
Yeah, so the senior deduction, it's an enhanced senior deduction, which is completely new for 2025 with the bill. That is $6,000 per qualifying taxpayer, qualifying senior. And those are the ones that are aged 65 and over. And so it doesn't matter if they receive Social Security benefits or not, they would be entitled to $6,000 per qualifying taxpayer senior, a deduction to their income. Now, there are income limitations for this. So if they are single, $75,000 and over of earned income, modified adjusted gross income that they do receive, that $6,000 starts to phase down. If they're married filing joint, then that's $150,000 of once their income has reached that level or above, that's when the phase out starts to reduce that $6,000 limit. But that is a new deduction, and it is not related to, and it's separate from the additional standard deduction that was for
Mm.
seniors anyway. We've had that in the past,
Mm-hmm.
which 2025, it's $1,600 per taxpayer. Or if you have a married filing joint return, it's a max of a $3,200 additional standard deduction for seniors. We've had that. This $6,000 is completely separate and new, separate from that additional standard deduction. And if we talk about homeowners, we have the residential improvements that we talked about that have that deadline coming up of December 31st,
Mm-hmm.
2025. And then we also have mortgage insurance premiums. Those actually will now be counted as mortgage interest, which would fall on Schedule A as an itemized deduction, but that doesn't start until 2026.
Okay.
Something else that did come when we're talking about provisions that were in existence with the with a one big beautiful bill, what it did, it made permanent the mortgage debt that you have on Schedule A was about to expire on that home debt of $750,000.
Mm-hmm.
That actually got permanently extended. So if you have a debt on a mortgage of your home up to $750,000, you're able to take that mortgage interest on your Schedule A.
Great. Thanks for the clarity and clarification. You said that does not go into effect until tax year 2026.
2026 is for the mortgage insurance premiums.
Okay.
We would be able to see those in 2026 on Schedule
Okay.
A if we have qualifying taxpayers. The
Okay.
senior deduction is 2025.
Gotcha. Okay. Perfect. Thank you.
I definitely need some kind of flow chart or so
I know.
to
We
put all
do.
these pieces together,
I know.
right? Right. And speaking of that, so just what is your final advice? There's so much in this bill. There's so much buzz around it. Clients are going to be calling with lots of questions. They're seeing things on social media. They're seeing things on the news. What's your final advice or even resources that you would suggest that people look at in order to kind of bring all these changes together and be able to understand and articulate them to their clients?
Yes. So I think, let's not get overwhelmed because there is a lot of information. Let's digest it, consult with our peers, refer to those sources of truth that we have, the Internal Revenue Code, the CPE webinars that we're taking, the articles that we're reading, and let's start prioritizing on what do we need to communicate to our clients today versus what's not going to be in effect until 2026, because we don't want to overwhelm our clients either and bring them everything that the bill has. Let's start off first with what's the most urgent. And to me, it is the energy credits that we have. The vehicle credit, the clean vehicle credit, that has an expiration of September 30, 2025. So this year. So yes, if they're out shopping for an EV, that's something we need to make aware because the purchase has to have been finalized by
Mm-hmm.
September 30th for that clean vehicle, that EV, that hybrid. And that's a credit up to $7,500. On previously owned, it's $4,000, or brand new EVs, that's $7,500. But the sale has to be finalized by September 30th of 2025. And then I would also start thinking about, okay, what's the next deadline after that? December 31st for those home energy credits. That's another communication. So let's start prioritizing, and then let's really start thinking about what affects the entire 2025. We're talking about the new deductions. For that, let's wait for IRS guidance for exact industries that qualify for the tip deduction, for the overtime, and how are those going to be computed and reflected on the W-2s, which won't be issued until next year in January of 2026. But at least we can start thinking about how do these deductions affect our clients, consult with
Mm-hmm.
our peers, keep up to date on those webinars, keep up to date on that education, use the resources that are out there, and let's start prioritizing and identifying clients that we can start reaching to.
I love that you just said like all these resources are already out. There's more coming out. There's a webinar coming up. So thank you so much just for getting ahead of this for our pros. And it's been so helpful in breaking down. It's a complex piece of legislation and that's been, all over. So really appreciate you today, Nadia, and just such a wealth of information. Thank you so much.
It's such a great reminder, right? Everything you talked about is stay ahead of the changes, make sure that you understand what's going on, communicate them with your clients. And it's not about just about compliance, right? It's about having strategic value for your clients year round. It's not just doing the tax prep during tax season, but it's so much more than that.
Absolutely.
And as tax pros, we're in this together. So let's really, we're not in this alone. We're in this together. Let's talk to each other. Let's consult with each other, bounce ideas off of each other on What are you doing to communicate with your client? Have you found a better method? Is it text messaging? Is it mass emails? Definitely, how are we communicating to our clients is number one. Let's bring that awareness to our clients.
Exactly. And they're leaning on all of you. I mean, I lean on mine, right? To guide me. So thank you again so much for today. That's it today for Carrie and Lexi Deduct This. Whether you're a seasoned tax pro or just getting started, we hope today's insights really help you navigate these changes with confidence, stay strategic, and get ahead. So we'll catch you next time.
Thanks for being part of Deduct This, powered by ProConnect Tax. If today's conversation gave you something new to think about, visit accountants.intuit.com for more insights and resources made for professionals like you. We'll be right here, helping you turn expertise into opportunity.